Understanding finance contingencies in real estate. Definition: a clause in the purchase agreement stating the buyer's obligation to purchase the home is contingent upon obtaining financing. Purpose: protects the buyer from losing their earnest money deposit if they cannot secure a mortgage. Conditions: typically includes a time frame, for example 21-30 days, during which the buyer must secure financing. The buyer applies for a mortgage loan immediately after the contract is signed. The lender assesses the buyer's financial situation, including income, credit score, debt, and employment. If the loan is approved, the contingency is satisfied and the deal proceeds. If financing falls through, the buyer can invoke the contingency to cancel the contract and recover their earnest money. Specifies the type of loan, for example, conventional, FHA, Virginia, and key terms such as the interest rate and loan amount. Defines the time frame within which the buyer must secure loan approval, for example, 21 days. Allows the buyer to recover their earnest money if financing is not secured within the contingency period. Requires the buyer to notify the seller if they cannot obtain financing. Safeguards the buyer from being forced to purchase without financing. Reduces the risk of losing earnest money if loan approval is delayed or denied. Sellers may prefer offers without financing contingencies, especially in competitive markets. Sellers can request pre-approval or proof of funds to reduce the likelihood of financing issues. Waiving a finance contingency may strengthen your offer, but comes with risks. Consider waiving it only if you have sufficient cash reserves to purchase without a loan. You are highly confident in your ability to secure financing. Obtain a pre-approval letter from a lender to reassure the seller. Offer a reduced time frame for securing financing to make your offer more competitive. Purchase price: $350,000. Loan amount: $280,000. 80% loan-to-value ratio. Contingency period: 21 days. If the buyer's loan application is denied within the 21-day period, they can cancel the contract and recover their earnest money. Get pre-approved. Secure a pre-approval letter before making an offer. Submit loan application. Promptly apply for the loan immediately after the contract is signed. Communicate with lender. Stay in regular contact to address any documentation or underwriting issues. Notify the seller. Inform the seller promptly if financing cannot be secured. A finance contingency is a critical safeguard for buyers, especially in uncertain financial situations. For sellers, understanding this clause can help you evaluate the strength of an offer. Both parties should work closely with their agents and attorneys to navigate financing contingencies effectively. Please call for any real estate needs at 470-269-0420. Syed Firoz, Realtor in Georgia.